A sudden silence has fallen over the world's busiest shipping lanes. Thousands of containers, once racing across oceans filled with everything from the latest iPhones to life-saving medicines, now sit idle, piling up like forgotten relics at Chinese ports. American retailers, the titans of global consumerism, are suddenly pulling the plug on billions of dollars worth of Chinese orders. This is not just a glitch in the system. It's a seismic shift with global implications. Boeing aircraft sit half-assembled, electronics factories slow to a crawl, and the American economy trembles under new tariff wars. So what really is happening, and are we seeing the collapse of trade worth $582 billion between the world's two biggest economies? In this video, let's know about the whole story. The economic fallout from the US-China trade war has taken an unexpected and explosive turn, leaving many US retail giants with no choice but to cancel their large orders from Chinese manufacturers. This decision, driven by a series of high tariffs imposed by President Donald Trump, has sent shockwaves through global supply chains. For companies that have long relied on the affordable manufacturing capacity of China, this dramatic shift presents an impossible dilemma: absorb the costs or raise prices and risk losing customers. In the face of these escalating tensions, large US retailers are opting to cancel orders, a move that is unraveling the once sturdy fabric of global commerce. At the heart of this decision lies a brutal truth. The tariffs have pushed the cost of doing business to unsustainable levels. For decades, US companies have enjoyed a lucrative and efficient partnership with Chinese manufacturers, taking advantage of low production costs. However, with the imposition of a 25% tariff on Chinese imports, many companies are facing a harsh choice between increasing prices and risking alienating their customer base, or absorbing the new costs and facing potential financial ruin. As a result, many US e-commerce platforms, big-box retailers, and large manufacturers have started canceling billions of dollars worth of orders, creating a ripple effect across the global supply chain. This decision has led to a severe backlog of containers waiting at Chinese ports, causing further disruptions in the logistics network. While this might seem like a temporary disruption, the broader economic implications could last much longer, as businesses scramble to find new suppliers or absorb the higher costs associated with the tariffs. With massive orders canceled and trade routes disrupted, Chinese ports are now becoming graveyards for thousands of containers. These towering stacks of metal boxes filled with products that were supposed to reach US markets sit unused and forgotten. Port operators in China are reporting a severe backlog, with containers piling up in storage yards, congesting key shipping lanes, and disrupting the smooth flow of goods. As a result, shipping companies are facing dramatic revenue losses, and the logistical backbone that has supported global trade for decades is beginning to crumble. Interestingly, this logistical bottleneck is not merely a symbol of supply chain inefficiency. It is a manifestation of the broken relationship between two economic superpowers. With every canceled order and every container left stranded, the damage to global trade intensifies. Manufacturers in China who relied heavily on US demand for their goods are facing crippling losses. Meanwhile, American retailers who have built their business models around low-cost Chinese imports are grappling with the fallout of their decisions. The impact on US consumers is already becoming evident. Store shelves are emptier than ever, and as supply becomes scarcer, prices are expected to rise. This shortage of goods, especially basic consumer items like electronics, clothing, and household goods, is only set to intensify as the tariff war continues. The deeper consequence, however, may lie in the long-term relationship between the US and China, as each side reassesses its reliance on the other and seeks alternative suppliers. In an increasingly dire situation, the number of freight vessels scheduled to arrive at major US ports has plummeted. For instance, the Port of Los Angeles, a critical entry point for Chinese goods, has seen its shipments decrease by 31% compared to the same period in the previous year. This dramatic decline is directly tied to the increasing tariffs imposed by the U.S. government, making imports from China less attractive for American companies. Before we continue further, tell us, are you enjoying the video? If yes, please like and share the video and subscribe to our channel to watch more videos on the latest news stories on geopolitics, economics, and current affairs impacting your lives. Now, with tariffs on Chinese products rising as high as 145%, many retailers have no choice but to reconsider their supply chains and cut back on Chinese imports. As the tariffs raise prices across the board, retailers are finding it harder to maintain their profit margins. For example, retailers like Target and Walmart, who have long depended on affordable Chinese imports, have begun scaling back orders. While some are attempting to negotiate better terms with their Chinese suppliers, the rising costs are proving to be too great to bear. And as the cancellation of orders accelerates, the ripple effect is beginning to reach the U.S. consumer market. Economists and supply chain experts are warning that these cancellations could result in significant shortages of goods across the U.S. By the time the U.S. government and its businesses figure out how to manage this new trade landscape, it may be too late to prevent widespread product shortages, particularly in consumer electronics and household items. However, as the trade war intensifies, China has shown little willingness to compromise. Despite pleas from U.S. retailers for price reductions to offset the tariffs, Chinese manufacturers have adopted a hardline stance: no discounts. While this may seem like an aggressive response, it reflects the growing pressures faced by Chinese suppliers who are also struggling with their own rising costs. Higher labor costs, increased raw material prices, and the adverse impact of tariffs on Chinese exports have left manufacturers with little room to maneuver. This has led to a standoff where neither side is willing to back down. U.S. companies that once found Chinese goods attractive due to their low costs are now faced with sky-high prices, while Chinese manufacturers are unwilling to lower prices for fear of eroding their own profits. As a result, a significant portion of trade between the two nations is being left in limbo. The cost of doing business is increasing on both sides, and the impact is rippling through industries that rely on the affordable exchange of goods. With the situation at a dead end, many American retailers are looking to alternative markets. Southeast Asia, South America, and even domestic manufacturers are emerging as potential substitutes for Chinese production. While these regions may offer cheaper labor or lower tariffs, they also lack the scale and efficiency that China has spent decades perfecting. As U.S. companies scramble to replace Chinese suppliers, they face significant hurdles in finding alternatives that can meet the same demand at a competitive price. However, the logistical challenges don't stop at just moving to new countries. Infrastructure, political stability, and local capacity all play a significant role in whether these alternatives can become viable. This makes the transition away from Chinese suppliers much more complex than anticipated. For many companies, the cost of shifting production to these new regions might ultimately outweigh the benefits, especially as they face rising tariffs in other countries as well. While the political rhetoric surrounding the U.S.-China trade war may sound like a battle for national interests, the reality is far more personal for everyday Americans. As U.S. businesses face increasing tariffs and higher costs, the consequences will trickle down to the consumer market. Products from electronics to furniture will become more expensive, and Americans already struggling with inflation will face even higher prices on everyday goods. The impact of these rising costs will be felt most acutely by low- and middle-income families who depend on affordable goods. With U.S. companies unwilling or unable to absorb the rising costs, the burden will fall on the consumer. For many, the choice will be simple: either pay more for products or go without. However, the effects of this trade war are not confined to the U.S. and China alone. Global markets, particularly those in Europe, Africa, and Latin America, will be affected as supply chains shift and manufacturing prices rise. The interconnected nature of the global economy means that this conflict between the US and China will have far-reaching consequences for countries that rely on Chinese goods or on US markets for their exports. The potential consequences are vast, with African countries, in particular, bracing for the economic ramifications of a prolonged trade conflict. Countries that rely heavily on Chinese imports, such as in Africa, may face even higher prices for goods and materials. At the same time, countries that rely on the US for exports may find themselves caught in the middle of a trade war that ultimately harms them both. Now, the question arises whether the trade war can be resolved, or is this just the beginning of a new economic Cold War? While both nations have hinted at negotiations, there is little indication that either side is willing to make major concessions. For now, the trade war continues to escalate, and businesses on both sides are left to pick up the pieces. One thing is certain: the status quo is unsustainable. The global economy cannot afford an extended trade war between the US and China. With rising prices, supply shortages, and strained relations, the world is facing an uncertain future. The next steps will be crucial in determining whether a resolution is possible, or if this trade war will continue to reshape global markets for years to come. Do you believe this US-China trade conflict will cause lasting damage to the global economy, or is it just temporary turbulence? Who do you think will ultimately pay the highest price for this trade war? The American consumers, Chinese manufacturers, or global economies? In the comments section below, share your thoughts on whether Trump is already regretting his tariff war and can reverse it now. Do you want to watch more videos like this one? If yes, subscribe to our channel and press the bell icon next to it. We bring the latest news stories on geopolitics, economics, changing world order, and current affairs. Things you need to stay informed. Thanks for watching, and until the next video, stay tuned.